Geopolitical uncertainty is undoubtedly nerve-wracking, especially for investors, and markets always react quickly to heightened geopolitical risk. I'm Mike Drozd, CIO for LaSalle Street. Stay tuned to learn what the current tensions mean for investors and for your wealth. First, we're seeing a familiar risk-off tone. But it's important to frame how the market was positioned coming into this year. Expectations for a continuation of the past 3 years of multiple and earnings expansion were already baked in, and bullish positioning was crowded. So it makes sense that during a geopolitical shock, we've seen the classic early moves. Oil prices move higher on concerns about supply disruption and possible closure of the Persian Gulf. Global equities move lower as higher oil prices, a stronger dollar, rising yields all tighten financial conditions, and gold moved higher as investors sought safety. But the bond market is telling a different story, one of steady economic growth with some inflation coming from higher energy prices. So we're not seeing the typical prices up, yields down pattern you'd expect in a traditional risk-off environment. In our view, this is very telling. And looking past the immediate turmoil, the bond market still reflects expectations for solid economic growth this year, unless the current conflict expands more significantly. That said, our base case does not assume a prolonged regional war, and given the recent military developments, that appears increasingly possible. These events reinforce a key message from our 2026 outlook. In a world defined by geopolitical instability and high market concentration, diversification beyond stocks and bonds is essential. And that's exactly why our investment committee made several strategic asset allocation changes back in January, well before this escalation occurred. Those changes included increasing gold exposure, trimming overall equity risk, and adding to high-quality fixed income while reducing duration risk. The key question now for central bankers is, how might central banks respond to an energy-driven inflation shock? It appears that there's a new playbook taking shape. Central banks no longer assume inflation expectations are well anchored. Instead, when there's a large energy shock, they are prepared to lean against the risk of inflation expectations, use more hawkish language, and tighten policy or ease less than expected if needed. And given the uncertainty around how persistent any energy shock may be, the most prudent approach is to start cautiously, then recalibrate as more evidence comes in. In closing, although geopolitical events are unsettling, it's important to look at the bigger picture. As highlighted in our 2026 outlook, we're in a period where structural change is the norm and a hallmark of fourth turning type eras. In times like these, investors should remain focused on their long-term goals, peak diversification across asset classes, and a disciplined decision-making process. For more information, please review our most recent CIO Insights publication, or feel free to reach out directly.